Thank you. Thank you all for coming. We are an insurance innovation hub, and what we're really trying to do is make insurance work for everyone. It's not easy at this time, and I'm going to talk a little bit about how we do that. But just to level set, we don't sell insurance. We are a nonprofit, and we try to work with communities, but we also work with the industry to try to think differently, innovate. Insurance markets really aren't working super efficiently. Overall, all catastrophe losses, about half of them are uninsured. And if you look at some perils like flood, the number is much higher. And we try to do it from two perspectives. You know, you probably heard a lot over the last 2 days on adaptation. What are the things you can do to reduce losses? That is critical. Insurance markets can't work if we don't kind of manage the increasing risks related to climate change. But there are also things in the insurance industry that don't necessarily work well, and we need to focus on that as well, making the insurance industry work better. And so what I really want to kind of define that crisis a little bit. There is this risk crisis. Risk is increasing. You've heard a lot about that. That puts pressure on insurance markets, and it leads to protection gaps. And we'll talk a little bit about what that means, but that's that 50% of people that don't have enough insurance or don't have insurance. And those are essentially unfunded liabilities that land somewhere. And we're going to talk about where they potentially could land. But the other market that is, I go to a lot of conferences like this, the other side of that coin is the insurance markets. Insurance markets can break in a lot of different places. And I'm going to talk through where they can break. And it's just as important for economic development planners and resilience planners to go to that next step of what we are calling insurability planning. If you're investing in adaptation, you want to make sure that the markets understand what you did and capture the value of it quickly and fully in the insurance markets. And that doesn't just happen. It needs to be forced in some cases. So we'll talk a little bit about what we mean there. And also in the middle, some people just don't get insurance. So, you know, maybe it's affordable, it's accessible, and people choose not to get it or don't get enough. That causes problems when the large catastrophes come through, because insurance is extremely efficient when it's in place to flood money into a catastrophe, you know, following an event, which enables recovery. If that doesn't happen, sometimes you find, and a lot of times people find after the fact, they thought they had insurance, but they didn't. And then that causes delays in response recovery. To manage any of this, the first thing when we talk to communities, is there needs to be an understanding of what we call the total cost of risk. And the total cost of risk is the losses that are flow through because of catastrophes. Those are increasing because of these climate issues that you've been talking about, I heard this morning. There's also the cost of investments in adaptation. The state of Massachusetts is estimating that $130 billion needs to be spent over the next few decades. I'm not sure what that time horizon is, but that's a lot of money. In theory, that reduces this, but this is increasing. So it's kind of a race against time. Can we adapt fast enough to stay ahead of the increasing loss costs? And then there is just a cost to transfer risk through insurance or other mechanisms to fund the catastrophes that flow through. And then there's response and recovery costs. These costs are dynamic. You invest in one area, it changes the other area. But it's really important to understand the relationships between them as communities are making decisions about where to spend the next dollar, and a lot of the conversations about where to retreat from, where to invest in, all sorts of, you can invest in asset level, kind of adaptation, community level, landscape level. The next thing that we say is, once you know the total cost of risk, it's really important to know, who does it land on? There's a lot of equity issues related to who it lands on. In addition to equity, there is like municipal financial sustainability in terms of especially the protection gap. There's been a lot of study of what this protection gap is, who has insurance, who doesn't, at a national level. But at a hyper-local level, it's really difficult to estimate, like, are these people insured? To what extent are they insured? It's not just about having insurance or not. It's about what are the size of deductibles? What is the limits of the policy? And that protection gap, and I was looking at the dates in some of those, those sessions earlier when those large catastrophes came through. We haven't got hit by a large catastrophe in a catastrophic event. When we look at catastrophes, we look at normal events like the one in 10-year, 5-year, 100-year events and 500-year events. Those are all increasing, but Massachusetts and has not been hit with like a Sandy level event or a Hurricane Andrew level event. It will, and what usually shows up is that protection gap is really recognized after that. So that's just a little context of the kind of the physical world and the financing of these things. I wanted to talk through the different places. I think everybody, when I go to meetings, when I talk in sessions and talk to people, everybody's like, what's going on with insurance? Insurance crisis, insurance is broken. But the conversation doesn't necessarily progress to where exactly is it broken. So we've kind of come up with this framework. Oh, sorry. There we go. We've come up with this framework that this is like the Maslow's hierarchy of needs, where every level requires the level below it to get to the top. And so each one of these levels represents a part of the market that can fail. And understanding where the market is failing locally helps you kind of intervene in the market, just like you're intervening in the physical kind of things that happen through adaptation, through nature-based solutions, through home asset hardening. So I'm just going to step through quickly, but at the basic level, this is just a technical ability to provide insurance, which requires modeling. It requires events to be fortuitous, meaning like an event that's definitely going to happen. So if you have a home that is going to definitely be washed away, the cost of insurance is equal to the cost of the asset. So that's not really insurable. So understanding this, just is it insurable? And when it comes to modeling, flood modeling is okay. It's not great. There's a lot of work that needs to be done. There's two major parts of insurance. There's the National Flood Program, which uses not very sophisticated modeling. And then there's private markets that use more sophisticated modeling. And when you have that, the more sophisticated modeling, what it does is it cherry picks the things that are overpriced in the NFIP program and pulls them into the private market, which makes the NFIP program more financially unstable. And you're seeing the private market grow, and they are pulling out the ones that are modeled incorrectly and priced wrong in one direction, though. They're not picking the things that are underpriced by the lower fidelity models used by NFIP. There's also an issue of availability products in Massachusetts. There were two companies that provided insurance products specifically for mobile homes. Mobile homes aren't a large percentage of homes, but they're a large percentage of affordable homes. And one of those companies pulled out. So there just isn't enough product to serve the existing market. And so the products need to be in place in the market. And then they also need to be accessible. And like one thing you see on Cape Cod is there are a lot of homeowners products. There are a lot of companies doing business on the Cape, but they also limit their exposure by saying like, I don't want to put too many eggs in this basket of, the Cape and Islands. So maybe the products are there, but they're not necessarily accessible to the extent that the market needs it. And then there's obviously the issue of affordability, which relates directly to risk, but it also relates to the ability of the community to pay. So people have different demographics, different wealth scenarios. And then the top layer is, just do people get it? Some people are like, I don't trust insurance. I don't like insurance. I'm just not going to get it. Or they don't know. The insurance industry is not super transparent. That people buy a policy, they think flood is covered. Our insurance policy is a contractual promise to pay. What is written into that contract really matters. Companies put exclusions and they're like, hey, it's a contract. There's a reason you got it cheaper. But people don't necessarily know that, and it's not necessarily clear, and they think they got one thing and they didn't. And all those end up being like will get you to an insured market. And one of the things that we think is an important metric for communities to kind of think about in this concept of insurability planning is this, what we call the UAAL, which is the uninsured average annual loss. The average annual loss is what the models say. If you have a good model that says, hey, based on the hurricanes and the floods or the hazards, we estimate that the average annual loss is X. Anything you invest in adaptation could maybe reduce that number. But the protection gap is the other piece of that puzzle, which is, how much of that is unfunded, that average annual loss? Oh, sorry. Apologies. So the other part is the insurance part, the uninsured part. So communities can look at resilience in terms of what can we do to bring the number down, or what can we do to get people more coverage? And you kind of do these things together so that when an event happens, it is, that's kind of, you can optimize your investments across both providing coverage so you are financially resilient and investing in adaptation at the same time to be physically resilient. So the whole area, so this kind of leads to like that optimization process. There's a whole bunch of physical things you can do. They could be at the home level. They could be at the community level. They could be at the landscape level, like nature-based solutions. Those all bring the losses down. But there are also things you can do in insurance markets. You can kind of promote or engage, with the insurance industry and say, we need very specific different products for our community based on our demographics and our risk profile, and have different, use different models, use, different policies that cover different things. So you can innovate the products. You can also innovate distribution. So if you're investing in affordable housing, instead of selling one policy at a time, you could embed insurance and procure insurance at a housing level or even at a community level, so you can close that protection gap just through your procurement practices. And then capital stack is, I'll talk a little bit about that on the next slide, but the insurance industry is a global financial industry, and it's dominated by reinsurance companies that provide the capital that back local insurance companies that provide local insurance policies. Global companies, tens and $50 billion companies operating out of Switzerland and London and Germany do not really understand all the things that you were talking about that are going on here in this local community. So one of the things that we've been promoting is this concept of community development reinsurance. And the idea is that reinsurance that is connected more locally, like the community development banks are connected locally to communities. They understand what's going on and they can be more responsive, more of a partner, and work with communities to insure the communities as all these investments are going on. I'll go through quickly. This is a overly complicated diagram, but we think this is a very complex problem and it needs more than simple solutions. And so just quickly, the way the way we're thinking about it is, one, you need to fund the adaptation. Massachusetts is doing some really good things on revolving loan funds and the climate bill to get funding for resilience. It's probably not enough. We're going to need a lot more. We need to get to that $130 billion, but it's a start. So there needs to be something that funds resilience, probably public-private partnerships. I just talked about community development reinsurance. Reinsurance that is closer to the community can then work with innovative insurance markets to provide the risk capital to back their innovation. If you're an insurance company that doesn't have their own capital, which a lot of them don't, and you have a better model and you want to create a product for the Cape and Islands that creates this cool, innovative product, you have to go to these global markets and convince them that it's a good idea. And that's not easy, and it takes a long time. So having a reinsurer that is more like a community development bank than like a global reinsurer will help catalyze the market to do more innovation down here at the companies. And then we also think you need some sort of regional resilience district that helps coordinate this kind of integration of, where is the lending going? What are the municipalities focused on in terms of adaptation? Where does the insurance innovation needed, and where is it happening, and how do we bring it to market? So this is kind of how we're thinking of it. And ultimately, in those earlier sessions, we heard a lot too about community engagement. We need really full kind of engagement from the risk owners, which is the business owners, the residents, the municipal leaders, even the utilities, to really kind of think not just about adaptation, but how do you create the insurance market of the future that we think is inevitable. The insurance market is going to change dramatically. And the insurance industry, they have one-year contracts. They are the canary in the coal mine because they can exit and they can change their pricing much faster than banks can, who have 10, 15, 30-year durations on their lending. Insurance markets can exit almost overnight. So, and we have a InnSure Insights Substack that has some deeper articles on all these things. I think I'm pretty much on time, right? Unbelievable.
Questions? Oh, let me give you a microphone. Sorry.
Thank you. Very interesting. I'm curious, does your organization, do you work with like buyers of insurance? For example, I'm in a small 31-unit condo development. Do you consult with organizations, associations, like that?
We are working with some associations around that mobile home issue. We're not a broker for that. So if the consulting is around procurement, probably not. If it is around innovation, we would be very interested in like if we find something is just broken and we want to kind of innovate, we would think about kind of how can we look at the total cost of risk? How can we innovate? We work with a lot of startup insurance companies to kind of create products. So, I mean, if you want to reach out and have a specific conversation, I'm happy to have that.
So one of the issues in confronting coastal resiliency and, in fact, environmental issues in general is general lack of recognition or low recognition of the fact that what people do locally with their own properties has a much broader impact. And so in thinking about insurance,
Yep.
When you're insuring your automobile, that is built in to the process, the recognition that you can cause other people damage with your automobile and you're required to get auto insurance. So shouldn't we be applying that same notion to flood insurance or general property insurance, that at least in regions where there are significant and well-recognized environmental threats, threats that a local property, if you don't do the right thing on your local property, you could cause problems for a lot of other people. Shouldn't we be requiring rather than recommending that homeowners, at least in what we might broadly call a coastal resiliency zone, that they purchase insurance? And were you obliquely referring to something like that in your presentation? And would that fit into existing insurance business models? Thank you.
So I would say those are not easy questions and answers, but it does get to what I was saying is you need to understand like that the total cost of risk and then where it lands. That's essentially a scenario planning exercise. And you don't want that to just happen. You want to kind of do the scenario planning and decide like where to put the money. And it's not just money. It is things like how does the regulatory environment, we're an innovation group. And so we try to work from the communities up and, from the industry back to find win-win opportunities. But there is a regulatory framework over insurance that does things like that. And also, the banking regulatory environment and other, the state could come up with a mandate just like, automobiles. So those are all things that I think if we're going to reimagine insurance, which I think we need to do, should be considered. And it's going to require a lot of conversation. It's going to require people to understand how insurance markets work.
Hi, sorry for cutting into your question. Going back to your diagram of the Maslow's hierarchy of insurance, what if there's a community or a property that just doesn't even hit the first level, that it is deemed uninsurable and insurance companies pull out like we've seen in a couple of coastal states?
Yeah, it's usually communities have challenges, constraints in multiple areas. It really requires but you need to take them sequencing. Like you need to sequence the kind of engage in to fix it. And what people tend to go to when we have these conversations, they're like, insurance is unaffordable. We need to, and what you see on the regulatory side is a lot of times the regulators, public pressures, like it's uninsurable. And, sometimes prices are artificially kind of just depressed to keep them affordable, which incentivize some really bad behaviors potentially. And so it's really important to address them from the bottom up, because sometimes if you address them the top down, it doesn't really fix the problem and it potentially makes the problem worse. Your point, if things are really broken at level one, this is where some kind of analysis around kind of the things that we're trying to build around total cost of risk analysis and where the market's broken can then inform both the managed retreat piece, like where exactly and why and when, but also one of the things we just wrote an article on that Substack, like managed arrival is just as a challenge as well. And communities need to kind of plan for the arrival of people because when it happens, and you saw this like following Katrina, Baton Rouge and Houston and other communities got inundated and it kind of broke their insurability. Like they ended up in places that, they probably shouldn't have if it was a more gradual thing. So yes, I think it was a long-winded answer, but yes. All right.